What's up, everyone? It's Scotty with MoneyVest. So, first of all, I want to wish you all a very, very Merry Christmas. I really hope that you enjoy with your friends and family this amazing day, and may Santa bless you all with very precious gifts of health, wealth, happiness, peace, and prosperity. So, enjoy this day. Markets are, of course, closed, but I wanted to go over and do a recap of the 5 investing lessons learned in 2023, as I'm sure there will be a lot more lessons. In this video, my goal is to break down the top 5. 4 are shared by our community members. So 4 of them are going to come straight from our members at Patreon and Discord, and I'm going to share the 5th one in this video. So again, hope you all enjoy this video and find it helpful. If you do, please make sure to drop a like. I am traveling, so the background is going to be a little bit different. But again, link's going to be down below if you're interested in joining us in our Discord and our Patreon. There is a 16% annual discount until the end of this month. And I do also want to mention that there is up to a 70% off on our courses, and the coupon code is going to be Santa Rally. So Santa Rally is the coupon. This sale is only valid for a few more days for Christmas, and individual courses are 50% off, and the bundles are going to be 60 to as much as 70% off with the link down below. So definitely do take advantage of that while it's still here. So the first lesson is going to be coming from one of our members. And they said that what I'm still trying to cement in my head is to learn what type of trader you are. I can barely check the markets, but for a few moments each day as I'm working well before the market opens and until after it closes, and yet I like to day trade based off of a feeling of what the market should be, which, as you could guess, is not a winning strategy. I have zero edge in this game, so need to stop this nonsense. I need to take a more long-term approach and just buy good companies or ETFs at good prices. The only short-term trades I want to allow myself is to when reacting, not predicting the news, like the last FOMC meeting. Okay. So there's always this big dilemma among investors, especially if you're just getting started. You don't know what is the right strategy for you, okay? You don't know. And look, whenever you're getting started with anything, doesn't matter it's trading or investing, but literally when you are finding your passion, when you are looking for your true calling, when you're looking for your purpose, what do? You try new things. You try new things out of pure curiosity. Right? So you do new things, you experience them, you figure out, okay, where does your interest lie and what are you really good at? And then you double down on those things. So just because, obviously one of our members said that I need to stop this nonsense. Well, it's not really nonsense. Every single data point that you learn, it's every single thing that you learn from the market is useful. Whether it's losses, whether it's, having that financial pain, whatever it is, it's data that you can use to then formulate your strategy and move forward and double down on one that works. So now this person understands that, okay, focusing on long-term companies with good ETFs, good prices, that's the right approach. And even if you do want to trade, there's nothing wrong with that. Like the way I have it set up in my personal portfolio, I would say 70 to 80% are long-term positions that I'm buying and holding for the long term, 5, 10, 20 years out. And the remainder is focused on swing trading, day trading, options, right? In cash included, the bond trade that we had, so being more tactical, and that's completely okay. So there can be a portion of your portfolio which is more active versus the other portion which is more long-term, more passive, that you don't really look at, don't touch. You're consistently just dollar cost averaging at good prices for good companies. And there can be two things, right? You don't have to just stick to one strategy. If you are really good and interested and curious for multiple strategies, you can test them, you can try them, see what works best for you. So it is really important to remember that whatever you learn from the market is data that you can use to refine your strategy in this game long term. The second one comes from Thunder. This year I learned how easy it is to lose the big picture. We get short-sighted by paying too much attention to what's happening today and what others do. I learned that no one knows what is happening next, and being in the spotlight makes us do stupid things. Keeping humble is not easy. I learned that less is more. Definitely agree there. And I learned that the only way to tame the stock market is not getting hooked up with it emotionally. I learned that everybody is smart in bull markets, and I learned that getting your strategy on paper helps. Merry Christmas, everyone. I could not agree more with that paragraph, word for word. It is absolutely spot on, specifically the fact that less is more. A lot of times when people join our community, they ask me like, Caddy, where are the trade alerts? Like, why aren't you trading? Well, that's because I have experienced this myself. Over the years, I've experienced that when I trade more and I'm making more decisions, my decisions, the quality of those decisions get worse over time. And I'm making more and more poor decisions, which leads to more losses, which leads to revenge trading. And as a result, I end up losing money, or at least I did in the past. As soon as I focused on higher quality setups, as soon as I focused on quality over quantity, my trade quality setups increased, my profitability increased, my consistency improved, and that's the bottom line. That's the key. Less is more, meaning look for quality and not for quantity. You don't need to be trading every single day. You don't need to be trading that often. Only refine your strategy, see what works, and only trade those setups. Don't get tempted by what other people are doing. It's very easy to compare yourself and your returns to other people. And as a result, you can start to ditch your strategy. In the world of investing, we call this a style drift. You ditch your strategy and you kind of start focusing and chasing returns. That's when trouble happens. So focus on your strategy, stick to your game plan, plan the trade, and then trade the plan. And definitely getting your strategy on paper helps, and less is more. Now, this right here is from another member. They mentioned the main thing that I learned is twofold: engaged in the reminder that there will always be other amazing trades and opportunities. The bond trade was epic, which you guys know we planned for this year, and I don't have to play catch up to catch it again. Gotta learn to let things go and look for the next trade. Reminder that patience is always the key. Sometimes the best thing you can do is sit on the sidelines in money market accounts until you are ready to make the next move. And once again, it kind of resonates with less is more, right? High quality setups versus constantly being on this mindset of trading. And if you are a beginner investor watching this video, trust me, you can learn from these mistakes. Like, we've made these costly mistakes in our trading and investing career, so you don't have to make them. When we're telling you less is more, when we're trading, like telling you that you don't have to constantly be trading, it's coming from actual reason and it's coming from experience. And of course, as they mentioned, that waiting for the right opportunity and being patient is very important. And another thing they pointed out too is the idea of when a trade has already happened, the last thing you want to do is chase it, right? Because as I've mentioned before, our analysis is on the risk and the reward. The moment the price moves, the risk reward has already moved, right? So let's say that I'm buying a stock at $1 and my profit target's $3, right? And my risk is 50 cents. So I'm risking 50 cents because that's where my support is, and I'm making or potentially looking to make $3. So the risk reward is really good. But now imagine the stock moves from $1 to $2, right? So it's already moved up, let's say 100%. Now, people looking at that trade idea are going to be looking at it completely differently. Now the profit target's up to $3, so the margin for upside is low compared to the potential for loss. So when the trade has already moved, the risk reward changes and it's already too late. And there's plenty of other trades idea out there. There's plenty of opportunities out there. There's not just one or two. There's plenty of opportunities out there that you can take advantage of. So don't get too fixated on the one opportunity that you may have missed and then you want to catch up to it. Look for other opportunities. Of course, as they mentioned in summary, you don't always have to be finding the trade. Patience, research, and waiting while getting modest yield is valuable time well spent. This right here was from Artsy, and they mentioned that what I learned from last year was to invest in great stocks long-term at great prices and hold. There were so many opportunities I missed from selling too early, such as my 150 shares of Palantir average of $10, cash in at $14, re-entered with an average price of $17. HIMS was another prime example. My average was $6, sold at $7.20. Should have kept that one too. Next year I'm holding PayPal. I think that one will be a winning long-term hold as well. Couldn't agree more. The first line, absolutely spot on. Investing in great stocks long-term at great prices. And I'm really, really happy. It makes me happy. By the way, these are all amazing lessons, you guys. Please continue to post that in our community so that we can create a list of all the amazing lessons learned in 2023. Again, get a good list going so you can, again, learn from other members and their mistakes and their experiences. But this is absolutely spot on. Why? Because it's not about great stocks, okay? To some extent, yes, it is about great stocks as well. But it is more important about great prices. And I'm so happy that Artsy mentioned great prices because everything can be worth buying if given to you at the right price. Think about it. Every single thing around you, if you buy it at the right price, can be profitable. Even if that price is $0, even if you get it for free, it can be worthwhile and profitable if given to you at the right price. So price determines your future returns. Always. The price you paid will dictate how much money you end up making in the future. If you overpay, you're probably not going to make a lot of money. If you underpay, if you get a good deal, if you buy it for cheap, you're going to get a great return. Okay? It all comes down to finding great companies at great prices. If you find great companies at the wrong prices, wait. If you find bad companies at great prices, don't buy. And of course, if you find bad companies at bad prices, of course, run as far as you can. But the goal is to find great companies at great prices. So those are the 4 lessons from our community members. And finally, I want to share mine, and that is that it all starts here. It all starts here, up top, okay? Your psychology of investing, your mentality towards investing, your emotional intelligence, that's where it all starts, and that's where it all ends. Because, as more and more people are becoming more accustomed to artificial intelligence and high computing and just trading algorithms and whatnot, there's going to be a time where the only difference maker in investing success is going to be what goes on over here, because that cannot be put into a machine. That cannot be replicated. We can replicate formulas and mathematical equations and analysis and algorithms and everything into a computer, and you and I can have the same exact analysis, but the difference maker between you and I is going to be what goes on in here. That is our emotional intelligence and our psychology when it comes to investing. So it's really, really important that we practice high levels of emotional regulation when it comes to investing. Try to be as cold as possible when it comes to investing, because the market doesn't care about you. The market doesn't know that you're participating. The market doesn't even know what stock you own. So it's really important to focus on the right opportunities and be as emotional-less as possible. Of course, you want to have some emotion with respect to like having a gut check, having a sense of what seems to be correct, inaccurate, right versus wrong. But the idea is to not let your emotions dictate your actions for you, not giving into your emotions, so that at the end of the day, you're buying high, selling low. And of course, you're selling out of fear or you're buying out of panic. Those are the things you want to avoid as best as you can. So I hope you all enjoyed this video and a complete update on the investing lessons for 2023, 5 of them. Keep sharing them in our community. I think this video is going to be super helpful and it's going to help definitely a lot of people. If you have any questions, feel free to reach out and definitely do check out the courses. Of course, the psychology course is available, 70% off. The coupon code is going to be Santa Rally. So always happy investing. I'll see you all in the next video.